Welcome back. We are busy with Class 7 investments, and the next session we'll be discussing in Unit 3.4 insurance as an investment. Insurance portfolios and policies in general is what we'll be looking at now. Life assurance is and always has been the only method of providing a large sum of money on the death or the disability of an investor, utilizing a relatively small regular payment. The significance of this can be explained by contrasting it with a regular investment into, let's say, unit trust. The estate of the investor in unit trust will receive the repurchase price of the units on the investor's death. In the case of a life assurance policy, the estate may receive much more than the underlying value of the investment, primarily if death occurs early. A life assurance policy therefore plays a unique role in an investor's portfolio of investments. Traditionally, an assurance policy is comprised of two elements. The one element provides for the premature death and the disability. The other element provides for investments into a portfolio of assets. The type of portfolio in which the investor invested depends upon the individual risk profile and the investment requirements. The trend now is to separate the risk cover from the investment portion. It allows transparency of costs, as the cost of the risk cover is known at the outset. The client can then decide what amount will be available for investment and invest it how he wishes. It is possible with pure endowment that to purchase an insurance policy purely as an investment vehicle. A pure endowment is an endowment policy without any life cover. The entire premium after costs is allocated towards an investment plan. Most plans also offer a minimum guaranteed return. For example, in the event of death of the investor before maturity, the beneficiary will be paid the value of the investment or the premiums paid up to the date of death, depending on which amount is more significant. There is no restrictions on the amount payable in the form of premiums. However, if the premiums are increased by more than 20%, a new restricted period of 5 years is created. However, no restricted period is created if the premiums are increased by less than 20% per annum. The advantages is that policyholders can participate in the growth of the capital of the life office or the growth of the investment plan chosen. It provides a hedge against inflation. The policy also offers a minimum guarantee at the end of the term, which is equal to or higher than the premium paid. It provides a guarantee against capital loss. Since the benefits are tax-free on maturity, the investor needs to take the proceeds when the policy matures. Instead, the proceeds can be left with the life office and allowed to continue to grow as a tax-sheltered investment. The investor can partially surrender a portion each year as a tax-free income to supplement his or her income. Let's just have a look at a pure endowment and an example of it. If the policy grows at, let's say, 9% per annum, the investor can withdraw the 9% free of tax without decreasing the capital. Let's say a male age 40, age next birthday, has a 10-year pure endowment policy. He pays 1,000 Rand per month and the policy grows at, let's say, 9% per annum after costs. His premium is obviously 1,000 per month times 12, which is 12,000 per annum. The illustrative value after 10 years in this policy will then be 193,514. That's now taken at a 9% growth over the 10 years. The investor could withdraw 17,416 per annum tax-free from the end of year 10, assuming a withdrawal rate of, let's say, 9%. So that is one way you can use your pure endowment policy. Often pure endowment policies are used to provide a low income after maturity It can be done by buying a matured investment or by extending the life of one's own matured investment. Low tax income is created by making partial surrenders of the policy. The insurance company pays the tax at a rate of 30% a year on the interest and rental income earned by the investment. It is advantageous to the investor with a marginal rate which exceeds 30% per annum. However, a capital gains tax liability is incurred by the investor who owns a second-hand or traded endowment policy. Let's have a look at sinking fund policies. In companies, the need often arises to create a cash reserve to meet possible future contingencies like a mortgage liability or a loan. Let's say they bought a truck and they want to pay it off in 5 years, but they also want to create a cash reserve. A policy on the life of the director may provide a solution to this need. A sinking fund policy may be instituted for this purpose. This policy is similar to an endowment policy. It's an obligation on the part of the insurer to pay a sum or sums of money to a person on a fixed or a determinate future date in return for the payment or the promise of payment of regular monthly premiums. The continuation of the policy is not affected by the death of any company member instituting it. There is usually no life assured on a sinking fund policy, which means that the policy will not become a claim on the death of the owner or the investor, but may be ceded to a new owner and thus continue in perpetuity. Let's have a look at profit participation or smooth bonuses. Policyholders participate in the performance of the assurance portfolio by way of guaranteed and or reversionary bonuses as declared by the insurer from time to time. The purpose of this method is to ensure that returns are smoothed throughout the policy period. The bonuses are smoothed by not declaring the full investment growth in periods of excellent performance and drawing on the reserves, which are in turn then built up in more mediocre performance periods. Profits are declared as a percentage return on the investment premium. Profits distributions tend to be conservative in retaining a buffer against years when the investment return tend to be low and or negative. Bonuses are declared as a vesting bonus, which cannot be taken away once declared, and a non-vesting bonus, which may be taken away partially or entirely if the market performs poorly. In the event of a maturity or a death claim, any existing non-vesting bonuses will be paid out. An important point to remember about smooth bonus policies is that if invested before a market crash, the investor would be better off than having funds in a market-related portfolio. Smooth bonus portfolios are particularly popular in times of market uncertainty and if there is volatile markets. If we look at the direct profit participation method, the investor can participate directly in the performance of a particular fund. A unitized system is used the same way a unit trust operates. In this case, the investor feels the full impact of the market fluctuation because the effect of the price of the units making up the portfolio. The investor has a wide selection of portfolios to choose from, namely equity-linked portfolios. These portfolios would typically consist of quoted shares and cash. Unlike unit trust, an insurance company can invest 100% of its portfolio in an equity portfolio. With the advent of asset swaps, the investor is no longer limited to a portfolio made up only of domestic equities. Also, the regulation relating to the amount invested in particular company are less restrictive than in the case of the unit trusts. If we look at the property-linked portfolios, invest in the property directly or indirectly. A property-linked portfolio will invest roughly in the following proportions: 15% in government and approved securities, and 85% directly in owned property, property companies, property shares, or convertible debentures, mortgages, etc. The advantages to the investor is that or she or he can participate in a diversified portfolio of property investments which are professionally managed. If we look at cash and short-term interest portfolios, these portfolios are provided as a parking lot type of investment. These portfolios can be extremely useful. Consider the investor with 2 years to retirement who has benefited from a significant bull run in the equity market. This portfolio can then be used to shelter the gains from a potential disastrous decline in share prices. Then you get your bond fund or bond funds. These portfolios invest in government and appropriate approved securities. They provide a high income return together with the possibility of capital growth. Using an insurance policy can be advantageous if the marginal tax rate of the individual exceeds the tax rate that's payable by the insurance company, which is 30%. If the individual is at a top marginal tax rate, let's say 45%, this is a significant improvement on after-tax returns. Then we can look at your managed portfolios. These portfolios contain a mix of investments, including shares, bonds, cash, and property. Because they are spread over various asset classes, the level of risk in these portfolios is lower than in a pure equity portfolio. Then we can also look at multi-managed or multi-strategy portfolios. These portfolios give the investor access not only to the insurance company portfolio, but also to the portfolios of other managers. For example, unit trusts. The insurer offers the client the choice of various market segments, which a specialist in that field manages. The funds may be invested both locally and overseas, and it is possible to have optimized funds that are designed to meet specific risk profiles. Multi-manager funds are also available. See the section on multi-management that we discussed earlier for more information. Although an endowment policy restricts the client from being in the policy for 5 years, if the tax benefits are to be enjoyed, it does offer the high-income individual investor the opportunity to practice tax arbitrage. An individual would typically be paying tax on an additional income, let's say at a rate of 40%. In an endowment, the portfolio in which the individual business is handled would then only be taxed at 30%. Then we can also look at traded endowments. It is now possible to buy into a portfolio of traded endowment policies. The advantage of this is that the investment can be diversified across several South African insurance companies. It means that if one company's portfolio performs poorly, the investor can be protected by having invested in other companies' portfolios as well. The disadvantage is the additional capital gains tax liability incurred in respect of any growth in the value of the policy. Right, let's have a look at switching and delinking. The investor can switch between portfolios. Another advantage to policyholders is that all market-related portfolios on policies contain a delinking provision. It allows the policyholder to change from a market-linked portfolio to a more conventional portfolio, while being allowed to preserve the gain made in the direct market-linked portfolio. In this way, an investor can take advantage of several years of growth in an equity portfolio and then convert to a conventional contract, allowing him or her to receive the full benefit of growth tax-free on maturity. Let's have a look at the resale of endowment policies. The market for the resale of endowment policies, or as it loosely termed second-hand endowments, is a popular investment option during times of uncertainty in the stock market. It is also an attractive option for individuals who pay tax at the maximum marginal tax rate of 45%. The process of endowments reselling involves the owner of an endowment policy ceding his or her standard policy outright to a third party for payment above the proceeds the policy owner would receive from the insurer on surrender of the policy. The slight premium on the price is that the original policy owner would have paid all the costs involved at the policy inception. The new owner will escape the costs, which would then have been incurred in taking out a new policy. In most cases, the buyer has no relationship with the seller. The buyer wants to acquire a tax-sheltered investment. These policies are most suitable if there is no life cover, a pure endowment, or a sinking fund. The new owner, as a cessionary, need not to prove an insurable interest in the life of the insured under this policy. It is less complicated, however, if there is no life assured. In most cases, the buyer has no relationship with the seller, so he acquires this policy outright. Thank you very much for attending this session. Our next session, we will be discussing shipping containers. See you in our next session.